Hello, everyone. We just want to talk about banks and money. So, a bank is a firm that makes profits by lending and borrowing. Just going to pop myself up here some temporarily. Um, Banks borrow from households. They basically take deposits from households, other banks, and the central bank. So, the central bank is the main bank within a given country. Those banks then pay interest on deposits, and the interest that they pay is lower than the interest they charge on loans. So they charge some folks for loans. They earn interest on those loans from those when they're paid back, and they pay people who have deposits interest rate on those deposits, which is lower than the interest rate that they charge. That's how they make profits. I have a picture over here of Monte dei Paschi di Siena. That's one of the longest running banks in the world. It's based in Siena in Italy. It has gone through various manifestations over the years. It's, as I said, very very old, but it needed a bailout in 2013 after some dodgy things occurred. Now, when we think about the different kinds of money that exist, we talk about base money, which is what we also call high-powered money. This high-powered money is basically notes and coins. So you can just take this, it's considered what is called legal tender. So legal tender is the money that is backed by the central bank, which is why I have these pictures of British pound sterling notes here. You can take those pound sterling notes and they have to be honored and accepted as payment by law. Now, obviously, this is becoming complicated in terms of how we think about electronic payments. So, the electronic payments that you make are still backed by the legal tender that you have in your bank, but that's typically when we think about those electronic payments, they're backed by the legal tender that you have in your account. Okay, now, so in terms of central banks, the central bank is the only bank that can create this legal tender. So in the UK, we've got the Bank of England, which I'll refer again to later. But I have a picture up here of the Sveriges Riksbank, which was founded in 1668, and it's in Sweden, and it's the oldest central bank in the world. It was actually followed in 1694 by the Bank of England, so not too much longer. Now, the Sveriges Riksbank, why do we think about that? Well, in economics, we think about the Nobel Prize in economics as actually being the Sveriges Riksbank prize in memory of Alfred Nobel. So when we talk about the Nobel Prize in economics, it's not like a Nobel Prize in the same way that it was for the sciences, it's the Sveriges Riksbank prize. We still call it the Nobel, though, and we poo-poo people who get too pedantic about it. So the central bank is usually owned by the government. It acts as the banker for the commercial banks. So commercial banks have to have a banker, and that banker is the central bank. And these banks, or these commercial banks, have accounts with the central bank, and they typically have to have deposits stored there as the reserves that they have. Now, by crediting the accounts, the central bank can then create money. So the central bank can credit the accounts of the commercial banks, and in so doing, it helps to create money. So commercial banks create money by making loans. So this is called bank money. That bank money does not equal legal tender. Now, that bank money is a liability to the bank, not an asset. So when we think about that, banks earn profits by charging interest on bank money. So just as a reminder, I'm going to pop myself back up here now. What we see there is that bank money, broad money equals base money, so that legal tender that we spoke about, plus the bank money. That bank money is the money created by banks as a consequence of the loans that they issue to various people. So what we think about here, they've got a $100 bank loan. So if we talk about Gino, who's a bonus bank gives Gino a loan. So Gino is someone, a private individual. Bonus bank, a specific bank, gives Gino a loan of $100. We've got the $100 bank loan, and we've got the $20 base money, and that's the legal tender. And therefore, the total amount that you have there with the bank's asset is 120. And then the bank's liabilities is the 120 payable on demand to Gino. So what we see there is that broad money, that's what we think about in terms of like the money in the economy as a whole, is that legal tender that we think about, the banknotes, like what you can spend in the store, and also the bank money, the money that has been created by banks, which is not itself legal tender. Now, so there are a couple different things that we have to think about with banks. So banks provide the service of what we call maturity transformations. So the important thing here, firstly, is that you can go to the bank and you can get your deposits back at any point in time. Those deposits are typically like assured also by the central bank. Now, the thing is that deposits can be withdrawn at any time, but loans only need to be repaid after a specified time. So you have a loan for like 5 years, for example, and then that has to be paid back over a period of 5 years. Now, that's also a liquidity transformation. So the deposits are meant to be liquid. The loans to borrowers are in fact illiquid, right? They can't just like the bank just can't suddenly say to you, look, I said that you got a loan for 5 years, but now in fact you no longer have that loan for 5 years. I'm changing it suddenly, right? That isn't something that we'd expect a bank to do to us when we have, say, a loan for a car or a loan for a home, where the bank then suddenly says to us, actually this 30-year loan that I sold you is in fact now a 5-year loan, or I'm actually calling it tomorrow. That doesn't typically happen with those kinds of loans. Now, as a consequence, there are two different kinds of risk that the bank can be exposed to: default risk and liquidity risk. We're going to talk about those in a little bit more detail, but default risk is basically as it sounds. Like, people can default on loans that they're meant to pay, and then when they default, well, that's a risk to the bank. They're not going to get paid back the amount of money that they were expecting to get paid back. Liquidity risk occurs when banks are thinking, well, they expect to need a certain level of deposits in their bank, but then if lots and lots and lots of people suddenly all want their deposits simultaneously, the bank may not have all those deposits in their bank as it stands. So, what does that result in? Banks make money by lending much more than they hold in legal tender. So they make money by loaning out more money than they keep in legal tender in their own accounts, and also then they typically keep in legal tender with the central bank. So a bank run is a situation where all depositors demand their money at once, and that may result in the bank failure. So I have this example here of the bank run on Union Bank in 1932 in New York City. So if we think about the lead up to the Great Depression, the bank runs that occurred at that point in time, that's what we have here. And so banks were failing as a consequence of that. And then later on, what you saw was the development of the FDIC, the Federal Deposit Insurance Commission, which resulted in people basically getting insurance from the central bank for these, from like the government basically, for the deposits that they had made at their banks up to a certain amount. So the important thing there is basically capped. So if you're a multi-millionaire, that's typically not going to be covered by the FDIC in the United States, or equivalent legislation here in the UK. Now, another way that banks can fail is by making bad investments, such as by giving loans that do not get paid back. And sometimes the government may intervene because, unlike the failure of a firm, a banking crisis can bring down the entire financial system. So a very big story about this was Lehman Brothers, which failed during the kind of 2007 housing and then banking crisis into 2008. And they basically shut down or went into bankruptcy on September 13 in 2008. And you can see there the sign for Lehman Brothers being taken down and carried by these two chaps. And so Lehman Brothers, very reputable investment bank, issued these subprime mortgage loans. And as a consequence, what happened? They basically said they went out of business. Right? And so, as a consequence of the global financial crisis and their lack of liquidity and inability to pay back the loans that they had, or to deal with the loans that they had issued, sorry. Now, in terms of how we now think about the money market, so this is where I have the picture of the Central Bank of England. So the Bank of England, which is the UK central bank. Banks need enough base money to cover their net transactions. So they borrow base money on the money market at what is called the short-term interest rate. Now, the demand for this base money depends on how many transactions commercial banks must make. So the supply of base money is a decision by the central bank. So the central bank is deciding how much base money to supply to these commercial banks. That's a decision that's being made typically by the central bank, the head of the central bank, and by, in say the United States, by the Federal Reserve Bank system and the Federal Reserve Bank governors. So those are folks who are deciding on that there. Now, when we think about the policy interest rate, we've got the interest rate on base money, which is set by the central bank. And I'm going to pop myself up over here. And then we've got the bank lending rate, which is the average interest rate charged by commercial banks to firms and households. Okay, so these are two different things. So what we can see here is that we've got the commercial banks, and the commercial banks respond to requests for risky loans from borrowers, and the loan demand depends on the lending rate. So these banks have a lending rate to borrowers, right? So that's one part of the system. We've got savers, right? So we've got the people who supply deposits to banks. So they put their money in the bank, and then those commercial banks set lending rates to maximize profits given the policy rate set by the central bank, so that's set by the central bank, and the perceived riskiness of the loans, to people like these borrowers, right? Now, what we also see is savers then lend money to the money market by buying government bonds. So savers don't only put deposits in these commercial banks, they also do other kinds of saving, such as buying government bonds. And when they do that, their money goes into the money market. Now, when that money market occurs, commercial banks borrow from that money market. They're like, yes, we want that money from that money market. So those bonds that people bought from the central bank as a means of saving, because they're going to get some interest rate on those bonds, they're like, yes, we want to use that money to be able to lend it out to these borrowers. And then when we have the central bank, how's that acting? It's acting in two different ways. The central bank is setting the interest rate in the money market, which we as consumers are thinking about in terms of buying different kinds of bonds. Now, to be clear, we're not the only people buying these bonds. Other kinds of banks or different individuals could be buying these bonds, so not just us as kind of residents in the UK. The commercial banks also have to put some money in the central bank as reserves. So the central bank thinks about the policy for the money market. The money market provides money to the commercial banks. Savers also provide money to the commercial banks in terms of the deposits that they have, and that allows the commercial banks to provide loans to borrowers. So in terms of the business of banking, you've got the operational costs, the salaries of bank officers, branch rents, and so on. You've got the interest costs. You've got to pay interest on the liabilities that they have. Now, the bank's revenues, they typically come from the interest and the repayment of loans. So it's they're making interest, and so people pay back the principals of the loans, and they also get interest on the loans that are paid back, for example, per period. And so the expected return is the return on the loans, taking into account the default risk. Now, what that means, right, is that some people are going to default, other people are not going to default. And so the expected return is the return on the loans that they make on net, taking into account the default risk of the different borrowers. So what you want to think about there is that what is typically going to happen is that less risky borrowers are going to pay lower interest rates. More risky borrowers are going to pay higher interest rates. Why? Because we need to make sure that those people who are more risky are going to basically be priced at the appropriate level given their level of risk. And so the kinds of things you might hear about is like the trade-offs of risks and returns, right? So greater returns from greater risk, lower returns from lower risk. So if you're a very low risk borrower, like the bank is going to give you a lower interest rate as a consequence of that, but they're not going to make that much money off of you if you pay them back, right? They want to find risky bets which have high interest rates where also they do not default. So that's the kind of thing you're thinking about there. Now I'm just going to shrink myself down a little bit more and move myself over here. Great. So we spoke about balance sheets previously, and we can talk about the kinds of things that are in a bank's balance sheet. So we've got cash and reserve balances that are owned by the bank, and they're immediately accessible funds. And for example, the percentage of the balance sheet there is something like 2%. It's very low. They've got financial assets, some of which, such as government bonds, may be used as collateral for borrowing. So remember I mentioned that like it's not just we as consumers and households that buy government bonds. banks will also have government bonds. Other institutions will have government bonds as well. So those kinds of financial assets are owned by the bank, and they constitute, say, 30% of a bank's balance sheet. And then there's going to be loans to other banks. Again, remember, these are the assets. So think that the loans to other banks is an asset for the bank, right? And then via the money market, those are something like 11% of the bank's holdings. Then they've got loans to households and firms, such as mortgages. That's a big proportion of this bank's balance sheet. And then we've got fixed assets such as buildings and equipment. That's only 2% here. We add all those up and we get 100% of their total assets. Now, we then have their deposits. So remember, the deposits are liabilities. Why? Because we as consumers can try and take them out of the bank whenever we want to. We've got the secure borrowing, such as that with collateral provided. Collateral could be some assets that you have. So, for example, if I was trying to get a loan and I owned a home, I could post my home as collateral for the loan that I want from the bank. I could have other kinds of financial assets too, such as retirement savings, securities that I own, these kinds of things which would be acting as collateral for my loan. Typically, the more collateral I have, the lower interest rate I'm going to pay for a loan that I have. There's also going to be unsecured borrowing where there's no collateral provided. So, for example, when I got a car loan in the United States, that loan wasn't a significant amount of money, something like $10,000. I was literally getting it in order to build up a credit score, sorry. And I was doing this even though I had the cash just to get the credit score. So I was doing this without collateral. Like the bank wasn't expecting collateral because the loan was pretty small, right? And we see here that that's around 16%. So we had 30% of the secured borrowing, 16% of the unsecured borrowing, and 50% deposits. And so in total, that sums to 96% of the bank's liabilities. And then we've got the total liabilities as like 96% as a proportion. And then the net worth is the one minus the other, which is 4. Right, so that's the remaining net worth of the bank. We could think about this as proportions and the percentage of the balance sheet, or you could think about it as actual amounts of money that sum to 100. So, as a reminder, your net worth is your assets minus your liabilities. The net worth of the bank is what is owed to the shareholders or the owners. It's called the equity, right? So negative net worth means the bank is insolvent. So what we saw here, where the bank has net worth of 4%, that means the bank is solvent. But if it were the case that these numbers were greater, if those were greater than 96%, right? Imagine that went up to like 102. That would mean that this net worth was like minus 2%. That would mean the bank was insolvent, right? The negative net worth would mean the bank was insolvent. Leverage typically describes the reliance of the company or the bank on debt. Typically, the leverage is, when we think about this, is total assets divided by net worth, right? Because that's giving you some sense of the reliance that the company has on the debt that it holds. So you could also go back to this and look at the total assets that the company has. So over here. And then think about its total assets divided by its net worth, and that could tell you the degree of leverage. So what do we have here? We've got 100 divided by 4, and that's telling us a leverage ratio of 25, right? So 100 divided by 4, leverage of 25. Now, when we think about what we've looked at the models of consumption smoothing, with consumption smoothing, we had Julia's choices when she had a lower interest rate of 10% and a higher interest rate of 78%. What we saw there was that her consumption today dramatically decreased from 58 to 35 when the interest rate decreased. Now what that shows us is if we have consumption now on the x-axis and the interest rate in the economy on the vertical axis, the higher the interest rate, point G, the lower the consumption now. As the interest rate decreases, we consume more now. And so that's showing us a kind of demand curve for consumption now based on the interest rate. Now, why is that? That's because the interest rate is the kind of price of money. So if we think about more consumption now, if I could save money at a So taking that 78% interest rate for the loan and flipping it over. Imagine I could save money at a 78% interest rate. Very unlikely, right? Which is actually, the problem here is that she's trying to take out a loan, and the loan repayment interest rate is much, much higher than she'd get on savings. But imagine that you could actually do that with a savings rate. Then you could think to yourself, oh, wow, okay, I've got this opportunity cost of my money, which is very, very great in terms of what I could have in the future versus what I have now. Now, here, there I'm framing it in terms of a savings rate, but the same is true when you have this loan, right? The loan with the 78% interest rate, what that's telling you is you're sacrificing almost 2 units of future consumption for every unit of current consumption. I say 2, I'm rounding up 1.78 to 2, right? I'm saying that's almost 2 units of future consumption for 1 unit of current consumption. Remember, 1.78, 1 plus the interest rate, 78% as we have over here. That's saying 1.78, around 1.8, right? 1.8, you're sacrificing 1.8 units of future consumption for present consumption that you could possibly have. Now, that leads us to the next topic, which is credit rationing, for which I'll make a separate video.